Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. In this video we will be evaluating the portfolio performance, discussing the portfolio composition, and revealing some changes I made to the portfolio. So be sure to watch through the end of the video. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Let's start off with the market's performance. For the month of November, the S&P 500 returned 5.3%. The market again hit all-time highs following the election of Donald Trump as the next president of the United States. In anticipation of his policies, the market has taken a decidedly optimistic view and valuations have soared. Here we can see that the S&P 500 had an overall good month. Big tech companies like Microsoft, Nvidia, Apple, Amazon, and Meta gained, while Alphabet fell. Over in our corner of the market, non-alcoholic beverage, consumer packaged foods, and confectionery companies fell, while farm products, alcoholic beverage, and restaurant companies gained. Again, the market seems to love restaurant stocks. November also had a few important earnings reports. Kura Sushi, a holding in my portfolio, beat on earnings per share, achieving 9 cents versus expectations of 2 cents. This was a 350% surprise to the upside. Black Rifle Coffee beat on earnings per share, achieving 1 cent versus expectations of -2 cents, a 100% surprise to the upside. Okay, let's move on to the portfolio performance. I deposited $100 into the account on the 1st of November, 2024, and at the end of the month the portfolio balance was $520.02. This means the portfolio was up $17.57 for the month, representing a 3.5% return for November. Given the S&P 500's 5.3% return, we lost 1.8% of alpha by not being invested in the S&P 500. I have been trailing the S&P 500 for a few months now. This was never the plan, but hopefully we are closer to a turnaround for the portfolio. Since inception, the portfolio has had a 6.3% return on a money-weighted basis, while the return on a time-weighted basis was 4%. Given the S&P 500's 10.2% return, we lost 3.9% of alpha by not being invested in the S&P 500 since inception. Essentially, we made up a lot of ground this month with big gains in select positions, but we are still trailing the S&P 500. Again, the first goal was to not lose money, and by this metric we are doing okay. But the stretch goal of beating the S&P 500 remains elusive. It is very challenging to beat the S&P 500, but every month I learn more about how to better compete. Eventually it is my hope that we will eventually surpass the benchmark. Now let's look at the portfolio moves for the month. First, I bought some more Wingstop on the 4th of November, Hershey on the 5th of November, and Celsius, Hershey, and Pepsi on the 6th of November. On the 7th of November I again added to my Hershey position and also bought some Celsius on the 11th of November. In addition to interest income earned on the cash balance, we also received a dividend payment from Starbucks. The compounding is just getting started. Okay, let's take a look at the portfolio positions. Let's look closer at each holding. Celsius remains my largest holding, with 4.44 shares at a cost basis of $34.78. This position is down 18.2%. Celsius makes up a ridiculous 24.3% of the portfolio. I continue to average down as Celsius remains not only one of the fastest growing companies in my portfolio, but it is also one of the most efficient at growing. Unfortunately, my position size is a bit larger than I would like, so I will look to add very sparingly, but I still believe there are more opportunities in the future to lower my cost basis. Pepsi is now my second largest holding, with 0.44 shares at a cost basis of $167.70. This position is down 2.5%. Pepsi makes up 13.9% of the portfolio. Pepsi is a nice steady company but has recently come under pressure. First with GLP-1 medications and now the threat of Robert Kennedy as the health secretary. Rumored threats are usually overblown, until they are not. I'm not planning any big moves here and will continue to hold. Chipotle is my third largest holding, with 1.1 shares at a cost basis of $49.67. This position is up 23.9%. Chipotle makes up 13.1% of the portfolio. I have not made any changes to this position but am looking to add when the opportunity arises. Chipotle remains one of the best companies in my portfolio in terms of fundamentals, the outstanding performance notwithstanding. Next, Texas Roadhouse, with 0.24 shares at a cost basis of $165.72. This position is also up 23.9%. Texas Roadhouse makes up 9.3% of the portfolio. I would love to buy more of this company but the valuation is now sky high. Nothing to do but wait. Next, my only food holding, Hershey, with 0.27 shares at a cost basis of $180.77. This position is down 2.6%. Hershey makes up 9.3% of the portfolio. Hershey has struggled for several quarters now and that may not reverse for some time. Still, with the valuation continuing to drop, I am sure management is using this opportunity to buy back shares. This should buy the company time until input costs, aka cocoa prices, come back down and sales return to growth. Next we have Wingstop, with 0.15 shares at a cost basis of $295.48. This position is up 11.3%. Wingstop makes up 9.2% of the portfolio. I really like this buy and think I had a pretty good level of aggressiveness in building this position. I will wait for this to drift down to add more. Now, we have the sushi restaurant Kura Sushi, with 0.19 shares at a cost basis of $52.09. This position is up a whopping 105.3% and is my best performing position. Kura Sushi makes up 3.9% of the portfolio. Obviously now I regret now add more aggressively to this position but the fundamentals were as strong at the time. Still, in retrospect the risk reward favored building a 10% position and letting it ride from there. I do plan to add if it falls below my cost basis again. Next up we have Dutch Brothers with 0.34 shares at a cost basis of $29.73. This position is up 80.7%. Dutch Bros makes up 3.5% of the portfolio. This is one where I wish I had bought more. The fundamentals were trending in a great direction but the valuation was high. Today the valuation is even higher and may go even higher now that the company's growth prospects are more widely known. Now we have the penultimate position, Starbucks, with 0.14 shares at a cost basis of $75.11. This position is up 36.4%. Starbucks makes up 2.7% of the portfolio. I decided not to add after Brian Niccol was announced as the new CEO and still think that was the right move. While it would have been nice to have had a larger position before Niccol took over, I am pretty hopeful that a buying opportunity will present itself in the coming quarters. Last, I have about 10.8% in cash that we will carry over to next month and also earned interest on. As far as the metrics for the portfolio, revenue per share growth, free cash flow per share growth, return on invested capital, cash conversion cycle, net debt to EBITDA, and earnings yield on cost are all worse now when compared to last month. The weighted average gross margin actually remained the same. I think this change in metrics comes primarily from season weakness in Q3. Looking forward, food spend has picked back up in Q3 and is now outpacing 2023 on a trailing 12 months basis. Where the market goes from here is anyone's guess but I like my portfolio companies. Again, I think the biggest challenge will be to add strategically to these positions while keeping valuation in mind. Many thanks for watching. What do you think about the portfolio? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.